Bank of Baroda, that's the big one in focus. PS Jayakumar, MD and CEO of Bank of Baroda, spoke with us about the quarter gone by. There was also Ashok Garg, ED of the bank, on the big loss that they've posted, the rise in provisions and the asset quality. This is what they had to tell us.
In the first 3 quarters of this year, we made profits, albeit small ones. And for a variety of reasons, including a lower pace of resolution, some changes in policies, which resulted in bunching up, but nevertheless desirable in terms of loss or loss recognition, resulted in the elevation. Bulk of it is all legacy issues, or almost all of it is all legacy issues, and largely comes from transactions or rather loan books in excess of 100 crores. I think we are at the end of that cycle. We may still have one more quarter where we might have some pain, but I think we are coming to the end of the cycle, and that should be helpful to see the change back and getting, so to say, the color in our cheeks. The other point, I think, notwithstanding the fact that the loss is an item that gets a lot of attention, the reality is we have done excellent well on growth. And when we talk about growth, we have had about 17.5 or thereabouts of growth in our advanced book. But it's also quality growth coming from data that we have shared in the analyst result of improved customer quality in terms of rating of customers, of those who are rated, and credit scores of customers who are retail or non-corporate. And so it's a combination of growth and a combination of quality. Now, this growth that has happened because of the various infrastructure investments that we have made, whether these are in the form of products, processes, people, or other forms of infrastructure, such as technology. So as a consequence of that, I think that the growth rates that we have got are sort of sustainable, because it's coming from a fundamental investment in changes in infrastructure and all of the items that I just discussed. Therefore, I think a combination of good growth, which we expect, which is evidenced, coupled with the tailpiece of the non-performing portfolio problems sorting itself out, we should certainly look for good results in this financial year. As far as the specifics are concerned, we would have a better sense of it as we end quarter one, because we would have some more data points, particularly in the way the NCLT issues are heading towards resolution.
We have seen that in the past 1 year, retail sector has done phenomenally, be it for private sector or public sector banks. But we have also often seen that a sector which is doing well will ultimately reach a saturation point, and then the slowdown starts. So do you expect the trend which is there in retail, which is very positive, will continue for the banks?
Yeah, the reason is because when you look at our market share, particularly in the housing segment, when we look at the new sourcing, our share is about 5%. So there is a huge scope for us, because when you look at the eco space, so far as the housing loan is concerned, you will find large number of players in the market. These are besides the peer banks, public sector banks, we also have the private sector banks and non-banking finance companies. And the way we have the demographic, the profile of the country, 294 million households, we see a great demand upcoming. And because the demand is now not only confined to metro and urban cities, it's coming from tier 2, tier 3 cities also, because there is a huge shifts of the consumption and the income level of those people is concerned. So we see a great demand for all the players. That is one aspect.
Sir, also, how do you plan to improve your profitability this year, and do you have a strategy in place for the bank?
So the revenue story is playing up. You could see that we grew our revenue by about 12% or thereabout. About 16% or thereabout as far as the revenues are concerned. So the revenue story is intact. So I don't think that should be a problem. It could get better as the non-performing assets come down. The interest income, the net interest margin will go up, and the revenue side of the story is pretty much there. It should happen. The reason why we made losses is the credit-related costs, and as those costs come down for reasons we have discussed, the profitability should be there. So, all said and done, our best estimate is that we should be in a double-digit return on equity in this financial year.
Right. So I'll take a question on NCLT cases now. As far as the stressed assets are concerned, so have the numbers of NPA peaked out for the bank? Also, we saw that Tata Steel acquired Bhushan Steel, but that is one of the biggest cases in RBI's first list. But there are so many others which are still pending, and that has sort of delayed the profit money coming into the bank's books by a quarter, is what the perception is now. So how do you see the progress going ahead as far as NCLT cases are concerned?
So the way to look at it is that as far as net slippages are concerned, they would definitely be on the lower side because bulk of the issues have been recognized over the last 2 years. And some of the accounts that were in the borderline have been recognized either because of change in the policies, quite rightly so, or because the customers naturally are becoming non-performing assets. There is still a watch list and still slippages expected, but they're by an order of magnitude substantially less. So the delta growth from here, even assuming recoveries aren't there, would be considerably lower. But that's not the position we're looking for. We're looking for recoveries to happen. And we are expecting that even though we might have missed this quarter from an NCLT perspective, and maybe next quarter also doesn't fully play itself out, we do think the third and the fourth quarter should bear good results. As far as list 1 is concerned, because it's weighted to the steel industry, the performance, the overall realization from that list would be much better. As far as list 2 is concerned, it's more weaker customers. We have a coverage of 55% or thereabouts on that sector, but there may be certain accounts in respect of which the provision coverage